My name is Mr Gwala from Siyaphikelela Tutoring, and in today's tutorial we will be accounting for the increases and decreases in income and expense items. These are the following things that you should have whenever you are watching this tutorial. Firstly, you must have your scientific calculator, your exercise book where you will be writing notes, and your pen. Please do note that this tutorial is guided by the GAAP principles of the accounting standards. These are the steps that one should consider when dealing with the increases or decreases in those two items, which are the income and the expenses. Number one, find the full amount before the increase or the decrease. Step two, determine the amount that was supposed to be received per month before the increase or the decrease. The third step, add the increase or subtract the decrease from the amount paid or received per month. And lastly, add the amounts accrued or subtract the amount prepaid or deferred. For example, we are given an entity called ABC Limited, and it has the financial year end of 28 February 2025. Additional information: rent is increased annually on the 1st of December of each year by 10%. The monthly rent before the increase was 5,400. The rent account reflected the total amount of 78,300 on the last day of the financial year. This increase simply means each and every year on the 1st of December, the rent is increased by the 10% of the monthly income or expense for rent. In this case, it is rent income. The question you should ask yourself is that how do we account for this transaction? Number one, so to account for this transaction, we should follow those 4 steps that have been stated in the beginning. Right, the first step says that we must find the full amount before the increase or the decrease. In this example, we don't know this 78,000 either. It's for how many months, so we must firstly find that out. So there are 2 things that you should know whenever you're dealing with rent income. It's either you will have deferred income or you will have accrued income. Deferred income is the income received in advance before the services are rendered, and accrued income are those income that are due but not yet received. This simply means the services have been rendered or delivered to a customer, but the payment for those services has not been received from the customer. In this example, we've been given that the monthly rent amount is 5,400. That means for the whole 9 months, for the period from 1 March until the 8th or the last day of November, the rent has been 5,400, and the amount that the rent has increased by, it is 540, which is 10% of 5,400. Step number 2, you must determine the amount that was supposed to be received per month or per year before the increase or the decrease. So the money that was supposed to be received per month before the increase or decrease was 5,400. If you multiply by this amount by 12, you will get 64,800. This 64,800 is for the full 12-year period from 1 March, the beginning of the financial year, until the last day of the financial year, which is 28 February 2025. We'll carry on to step number 3. So in step number 3, we should add the increase or decrease to the amount that must be received or paid per month. So we know per month the rent is 5,400, and the increase, the percentage increase, it is 550. So we know from the 1st of December to the last day of the financial year, which is the 28th February 2025, we know that is 3 months. So 540 multiplied by 3 for 3 months will give us an amount of 1620. So we must add this increment amount. So from 64,800 we should add this amount to get a full amount that will be recorded in the statement of comprehensive income, or the statement or the income statement for the year ended 28 February 2024. So the amount that should be seen in the financial statement, it is 66,420. Step number 4, we must add the amount accrued or subtract the amount prepaid or deferred. We've been given that in the rent income account we have 78,300. So we know the amount that must have been reflected in this account was 66,420. This simply means there is some amounts that have been prepaid or they are deferred. That means we have received certain amounts in advance. So we don't know how many months have been paid in advance. So we are to determine that. So if we subtract this 66,420 from this 78,000, you will get 11,808. This 11,808, it is for 2 months. How did we determine that? We said 11,880 divided by 5,940, which is a rent per month, plus the increment of 540, which you will get 2, which simply means this 78,300 is the amount for 14 months. So as we are guided by the accounting standards, we, in this case, the matching principles, the expenses in income, we only want those items for 12 months. If we've received those amounts, those items for a period longer than 12 months, we must subtract all those amounts that are prepaid or are deferred. So in this case, the result we have been encountered for this transaction. I thank you.